So this video is response to Professor Damodaran's video, which was prepared on Fed reducing the interest rate by 50 basis points. And for him, it was the least favorable topic. But for me, it is the most favorable topic because I am macroeconomist as well as monetary economist, and I know finance also very well as I am a CFA charter holder. So Professor Aswath Damodaran posted the video with the title "Fed Up with Fed Talk, Central Banks and Interest Rates, Fairy Tales and Facts." So first of all, I would say that Fed talk is not actually, it is so interesting that you may not get fed up even if you talk for it for the whole life. And the reason is that it affects, the Fed affects your daily lives every day. And how the Fed affects that I will explain, responding to each point of Professor Aswath Damodaran. So let's start with the details. And he says that on Wednesday, September 18, Fed cut interest rates by 50 basis points, means half percentage. And then he says that is the Fed really the leader or what? So his question is Fed the rate setter, or is Fed a rate leader, means the leader who sets the rate, or if he's not the leader, then is Fed as signal man, means the Fed gives only the signal to the market, and the Fed as a stock market whisper, means does Fed whisper to a stock market whether to go up or to go down. And the stock market does change a lot. There is a lot of volatility in the stock market when Fed Chair Jerome Powell speaks on a Wednesday after 1.5 months. So he speaks 8 times on a Wednesday after the Federal Open Market Commission committee meeting, means FOMC meeting. And at that time, the stock market is probably most volatile. So let me answer his question. He said that is the Fed a rate setter? He said no. And my answer is yes. And that is because Fed is only one organization. There are multiple banks like JP Morgan Chase Bank, Bank of America, then there are mortgage companies, there are insurance companies, then there are big corporations like Apple, Microsoft. Well, Fed is only one organization, and it is a private organization, though its chair is appointed by the President of the United States. So since Fed is only one organization, it would be fair to tell that Fed can set only one interest rate in which it has expertise. And as the name suggests, that the Federal Open Market Operations Committee, FOMC, sets the interest rate, and Professor Damodaran said that yes, it sets the federal funds rate. Very good. Then, of course, the Fed is entrusted to set up only federal funds rate, and the Fed does his job. So the Fed, by setting the federal funds rate, Fed has done its job and it has set the interest rates. Now, Professor Damodaran said that why Fed doesn't set interest rate, because the mortgage rates are not part of, because the federal funds rate don't impact his life. Mortgage rates set by mortgagors who are the lenders, and then there is conforming mortgage for which Fannie Mae, Freddie Mac. These are the two biggest public sector undertakings which set the mortgage rates, which decide the conforming conditions, and they also decide the mortgage rates. They are basically lenders. Then there are banks who are in the business of making mortgage loans, and then they set up non-conforming loans as well. So if you qualify for conforming loan, Fannie Mae or Freddie Mac will be serving your purpose. Otherwise, you go to the banks. So that way, well, setting mortgage rate is not the job of Fed. Then Fed will not set that interest rate. That is the job of Fannie Mae, Freddie Mac, the two biggest organizations in the United States, and they set the job. Then what about credit card rates? It is the banks who issue credit cards. And so they decide the credit risk. And that credit risk, your personal credit risk, will determine the interest rate that the banks will charge. So that is above the Fed prime rate. So prime rate is 3% above the federal funds rate. So federal funds rate are the rates on which one bank lends out to another. So obviously, charging the rate for credit card is not the job of Fed chair, so he cannot set that rate. That is the job of banks. They decide. Then what about long-term interest rates, like 10-year corporate bonds, then 30-year mortgage loans? So mortgage loans, well, I already said that it is the job of Freddie Mac and Fannie Mae. Then about this credit card, it is the banks who are in the business of banking. Then what about deposit rates? Well, if you deposit with the bank will set the rate. And if you deposit with great companies like, means if you buy the bonds of corporate bonds like Apple, Microsoft, or General Motors, or whoever banks, whichever bond you purchase, it is the borrower who will decide the rate, that how much rate are they willing to pay. You are the lender, but you are a small lender. There is one of the thousands or millions of lenders, and so you don't have the market power. So thus, it is the market power, the credit rating of the corporations that decides the interest rate. So there are many players who decide interest rates, and Fed is only one of them. Fed decides its interest rate for which it has the authority, and that interest rate is bank rate and federal funds rate. So federal funds rate are slightly different from bank rate, because bank rate is also called discount rate, and it is higher than federal funds rate because when the banks have to borrow money from Federal Reserve anytime they need, means they run out of liquidity, then they have to pay the bank rate. Otherwise, when they borrow amongst themselves overnight, and why do they borrow? To meet their cash reserve requirements. So that rate is determined by the FOMC, Federal Open Markets Committee. So that is the FOMC, well known, and so that's why it is a federal funds rate. So that way, it is true that Fed is a rate setter for which it is entrusted, and that rate is federal funds rate and discount rate, and these are called short-term interest rates. Okay, so here, if Professor Damodaran says that Fed is not the interest rate setter, then he is confusing with the authority of the Fed and the authority of other organizations, or I would say the work domain of the Fed with the work domain of others. So obviously, if I am running a company, then I will decide about my company. Same way, Fed doesn't run the credit card business, so the credit card business would be decided by the banks. The Fed runs only the short-term interest rate, and that it has been entrusted with the Congress by law. So that is what Fed decides. Then second, the Fed as a rate leader. Here, he somewhat agreed, and then he gave only one proof that, yeah, Fed can be a rate leader with one test, and the Fed passed that test. That was that when the Fed set rates, all the rates followed. And that graph is here. Let me see, where is that? Yes, here. Here in this graph. So in this, he used only rates, and those three rates were, sorry about that, this advertisement. So Fed set this rate, and he says that, well, this is the rate that he chose. Then he chose this rate, and let me see one more place. He had here. So this is the test of his Fed setting as the leader of interest rate. So Fed rate is the lowest one. That is what he had shown. And then there are many different rates, and you see that there is high correlation. So when federal funds rate is up, all other rates are up. When federal funds rate is down, most of the rates are down. So Fed chair is, or I would say Fed chair has only one vote. So I would say Fed as a whole is also the leader in setting the interest rates as per this test. But Professor Damodaran doesn't like this. He is biased by, he's having this confirmation bias, and so he's going to choose the another test. And that test he chose is that of treasury rates. So here he says that here in this test, he says that the treasury rates, the 3-month treasury following quarter. So he said that, well, federal funds rate increased 96 of the times, but in the first quarter, 3 months, the treasury rates fell. Okay. The federal funds rate decreased 132 times, and treasury rates also decreased. So here it is agreeing, but well, it didn't agree here, and it agreed here, and no change. Still treasury rate also practically no change, 0.2. So I would say that out of 132 plus 98 is 230, and plus 21, 251. 251 times, about 51 times the treasury rates followed the Fed rate. Means when the Fed rate fell, treasury rate also fell, and when there was no change, then there was no change in the treasury rates as well. But 96 times out of 251, which is about how much? 40%, and 25, 96 divided by 24%, approximately. So 24% of the time, not 24, should it be 250? No, it is 251. So 96 divided by 251 is 25, 40%, about 39%. So 39% of the times, Fed increased interest rates, but treasury rates decreased. And so he says that Fed is not the leader in setting the interest rate, because the correlation of federal funds rate direction and the treasury rate directions are quite low. Obviously, they will be quite low, because if 40% of the time this is going opposite, means treasury rates are going opposite, then there would be no correlation. And well, this is not the confirmation that Fed is not the leader. This is, here Professor Damodaran is wrong in saying that treasury rates should follow federal fund rate. Why should treasury rates follow federal funds rate? Treasury rates are set up by the US President, United States government. Fed is another body. So there are two bodies. One is monetary policy, headed by Fed, and the other is fiscal policy, headed by President of the United States. So it is the President of the United States who decides, of course, advised by Treasury Secretary and Council of Economic Advisors, that what should be the level of debt and what should be the level of employment in the economy, what people really want. He's a politician, and he wants to keep people happy. Fed is a private organization. It is not interested in keeping people happy. It is interested in, well, I am not saying it is not interested in keeping people happy. Its primary goal is to control inflation and promote employment. Whether people are happy or not, whether this president is going to win election or not, Fed is supposed to be independent of that. Now, the president has to retain his job. When he is standing for the second time, or even if it is a Democratic Party or a Republican Party, they want their candidate to, even if the president has completed the 2 terms, still, like the Democratic Party, would like to have the next president from their party, or Republican Party would like to have their president from their party. So that way, the politicians are more guided by the needs of the people, and that is short-term needs of the people. So during so they are not supposed to follow the rates of the Federal Reserve. And also, why will they follow? The president is the boss, means he appoints the Fed chair. So why would he follow the Fed chair? He has his own priorities. So the president is the head of the United States government. So he would decide the fiscal policy, which doesn't have to be as per the Fed. So it often happens that sometimes Fed and President of the USA disagree, and both are independent in setting their interest rate policies. So treasury rates, how much treasury bonds to be sold in the market is decided by the president, and in that case, the rate will be different. Second thing, right now in Corona, the Fed was tightening monetary policy, but President Biden was sending checks to the people to expand the economy, which would not contain inflation, but would rather help inflation. So in that case, Fed raised interest rates to contain inflation, but President Biden had the priority over this inflation of feeding the people. The people had lost jobs. They needed money to survive, and President Biden provided them money. He just simply sent checks to the homes of the people. I also received some money. So that way, the treasury rates means he issued more bonds. And if he issued more bonds, then what would happen? The rate of interest, if the Fed is tightening, then when there is more supply of bonds, the market will say that the price of bonds must go. And the price of bond is discounted. So the rate of interest paid by these new bonds would be lower. Okay, so if the people are, what I am saying, that if there is more supply of the bond, means the bond, treasury bonds, means the price of the treasury bonds will be lower because there is increase in supply. And when there is the price of the treasury bonds is lower, then it would mean that the interest rate paid by treasury is higher. But what if it is the opposite way? Means Fed is making the policy tight and treasury supply is also low. So in that case, the price of the treasury would be higher. So if the price of treasury is higher, then interest rate will be lower. So it is very much expected that the president and the Fed chair won't agree, and so these rates of interest are not supposed to be correlated. So that's why Fed is not the leader of treasury rates. Okay. After that, his third point was that does Fed give signals to the market, and he gave the data. Okay, he gave here this data I already discussed. So he gave the data that can give signals. And what is that signal? That signal can be that the market, that you can be that the inflation is going to be less or the inflation is going to be higher. So here is the signal that is Okay, so he talks here about this. So after this, he talks about here this signal thing. So signaling means Fed rate only gives the pulse that whether the inflation has stopped or not. So in that case, he says that if the Fed reduced interest rates, means federal funds rate, not interest rate, federal funds rate for which the Fed is authorized by 50 basis points, if I am optimistic, I would believe that yes, the inflation is under control, and that is what I believe because I am an optimist. So inflation is under control, and this interest rate would be reduced even further in the future. So many people are expecting that. And but if I am a pessimist, which I am not, then I would expect that the economy has gone down, and that's why Fed has reduced interest to stimulate the economy. But that is not the case right now because the unemployment figures are very low in the United States. Everybody is having jobs, so that part is not true. And the third signal is that, well, there is going to be election after within 50 days. And so the Fed has reduced interest rate to favor their party candidate, which obviously looks like Kamala Harris. But I don't subscribe to that view much because Fed is supposed to be independent. And many times the president and the Fed chair have disagreed. So Fed does its job independently of any political pressures, and it has the twin objective of achieving full employment and containing inflation. So whenever there is any disbalance, means inflation is high, then the Fed would like to raise interest rates to control the inflation. And when unemployment is high, economy is heating, then also Fed would raise interest rate to contain expected inflation. And then when the economy is moving towards recession, Fed would reduce interest rates so that more companies borrow and consumers also borrow cheaply, because we saw that the interest rates, means credit card interest went down, then those interest went down, but other interest also went down, means the another thing is that many companies like Apple, they borrow from the market cheaply and invest in bonds. They buy in those bonds which pay higher interest rates. So Apple, what does Apple doesn't make money only by selling iPhones or watches or laptops, but they also make money by borrowing cheaply from the market and lending expensively in the market. So they buy bonds cheaply because their credit rating is very high, and then they lend expensively because they assume some credit risk and make some money. So in the last 12 months, they made about $4 trillion. So here you can see, here is the Apple income statement on Wall Street Journal. And you see that is the sales revenue is 383 billion. Okay, that's fine. This is what is their sales revenue. So this is the income statement. Let me go to Yahoo Finance where it shows better. And this one is the balance sheet. And okay, so income statement I'm using Wall Street. I can find here as well. So here, since I have opened balance sheet, so in the balance sheet you see that total assets is 352 billion, and out of this, here is invested capital. This part, invested capital is 173 billion. This invested capital is that Apple has borrowed money from the public cheaply and invested into the bonds of other companies. So this 173 billion means half of the assets of Apple are bonds which have been invested in other corporations or at higher interest rates. So Apple borrowed cheaply, it didn't pay, then also its accounts payable are higher. So Apple borrowed cheaply and then invested to make money. How much money did he make? How much money did Apple make? And here it is in the income statement of Wall Street Journal. And we go down little bit and we see that here is the interest income. It should be somewhere. Yeah, here. Interest, gross interest expense and gross interest expense growth. Okay, interest expense is the interest income. Net operating, here, yeah, here. Net operating interest income. So this one is 3750 billion, means about $4 billion. So this $4 billion has been the interest income that Apple earned from that investment. So this shows our sales growth for this 2023. This is for the year 2023 here, yeah. So for the year 2023, and then it also paid interest because it issued bonds. So how much did the interest did it pay? So you can see that Apple earns interest. So Apple earned interest expenses 3993 billion, means about 4 billion too. So gross interest expense is this much. What is the net interest income? It is income minus that. So this should be there. Interest expense, net operating interest income is this much, and net operating income expense. So here this Apple actually lost. But what will happen when the Fed rate goes down? Apple can borrow cheaply and then invest expensively. So this year in 2023, it doesn't show very good picture for Apple. It paid more interest because the interest rates were high. Right now, the Fed interest rates were very high, so it paid more interest. And it couldn't lend at higher interest rate then. So if the interest rate went down, Apple is expected to earn more, and that would reflect in immediate rise in prices of Apple. So let's see if the Apple Inc. prices rose. So here is the price of Apple Inc. It was on 18th, when is this? 9/18. So this one is on in the morning of 18th. The price of Apple was, stock price was $215. 9/18, no, about $216. And then within 2 days after the rise of interest, it reached $232.73. Means $16 rise out of what? 215, means around 7% rise. So the 7% rise happened because Fed reduced interest rate by 50 basis points. So why did the 7% rise happen for Apple? Because Apple is a technology company. Their stocks are more interest rate sensitive, and also Apple will earn money by borrowing less and then investing in higher paying bonds. So Apple is going to benefit both ways. So that comes the fourth part that proved also so it gave the signal of interest rate, and it also gave the whisper to the stock market. So you see, this Apple rose by 7% within 2 days after the interest rate was dropped. Then we have this SPY, the entire 500. Here you see, just after Fed announced interest rate cut, it jumped from 563 to how much did it go? To 572, means 9 points, about 2%. So SPY, which is having the broad measure of entire stock market, it rose by 2% within 2 days. So that way, Fed whispered, the stock market listened, and it reacted by rising by 2% for the entire index of 500 technology stocks. How much did they go up? Let's see. One of the technology indexes is QQQ. So let me check here. How much did QQQ rise? So it should rise more than 2%. That's for sure, because it is a technology. So now it is 483, but how much was it on 18? So let me have it for 5 days. Yeah. So for 5 days, you see, here also the technology stock jump. Where was it? It was 473 or 473 before the rate announcement, and it went up to 486. So 13 points out of 473. So it is about around 3%, more than 2.5%. So that way, the Sensei Technology Index, it was faster than broad index, and Dow 30 would have fallen less, would have risen less. It would have also risen, let's say, Dow Jones, DOW, Dow. So Dow Inc., how does it do in the 5 days? So let me go down, and Dow rose by, here you see, Dow also rose. It is on 918. So from here, it was 5178, and then it went up to high to 53. So about 0.5%. So Dow also went up. Now, Dow is the Inc. of Dow Inc. Is this Dow Inc. or is Nasdaq real time? Is this the same Dow? Okay. So all the stocks market went up. That was the whisper, that a stock market whisper, which Professor Damodaran talks, that it whispers to a stock market to go up or down, and the stock market did the job as per the Fed whisper. Now, the whisper lasts only for 1 or 2 days. After that, there will be new news, and that news may decrease the market. That doesn't mean that the Fed didn't do its job. The Fed did its job, but then that lasted only for 2 days. Or how long should it last? The stock market is very efficient, so any news shows immediate rise or immediate fall in the prices. So what were the 4 points that Professor Damodaran said here? The 4 points were, and actually Fed has done a great job in all. The Fed as a stock market whisperer, yes, it works a lot. Stock markets are very volatile when Fed chair speaks, and the stock market rise and fall swiftly as when the Fed chair concludes. About this signal, Fed as a signal, yes, the Fed gave the signal that the inflation is going to remain muted, and there is no scope, or there is little hope that this 50 basis point doesn't mean that this economic is in recession, because unemployment data showed that unemployment is quite low, hence economy is not going to be under recessions. And then about political signaling, well, Fed is not supposed to give any political signaling. They are supposed to be neutral. So, and that's a very weak, I would say, and very few people agreed that, well, probably it is the election which caused this. Well, Trump would agree because it went against Trump. So Trump would say that Fed has reduced interest rates to help Kamala Harris. And Kamala Harris would say that no, she has not got any help from Fed. So, well, politicians keep on talking, and you don't have to take them seriously if you are a serious economist. Okay, otherwise, well, people take the politicians' words seriously, but most of the time, the politicians give biased opinions. So, Fed is the rate setter for sure, and that rate is federal funds rate and bank rate. So 2 rates are set by the Federal Reserve. Then Fed as a rate leader, yes, it is the leader because other interest rates determined by the market, and which are what I would say, followers of the Fed, like banks. Fed is bankers' bank. Companies, they benefit from lower interest rate because of their interest cost is reduced, so that would increase their profits. So it is the companies who also benefit. So that way, Fed as is the rate leader too. and Fed gives very good signals. And then Fed does influence the stock market. So Fed is all potent. And if Fed is run by great economists and finance professionals combined, because the finance professionals will give the information about the implications of Fed decision in the corporate world, and the economists know about the macro impact like GDP growth, inflation rate, unemployment reduction. All those are the job of economists or a specialty of economists. So Fed should be proactive in the market and in managing the economy. Most, if the Fed is really right, then it can achieve the US economic growth not by 3% or 4%, but by rather even 10%. Like China has achieved growth for 10 years, rather 2 decades, at the rate of 10%. Why USA doesn't do that? Because Fed is not run by very good economists. Fed chair is not an economist either. Mr. Jerome Powell is a bachelor in economics and he is a law graduate. So he's not, I won't say that he's doing good job or bad job. I am nobody to comment him. But the expert chair can achieve the growth of US economy at the rate of 8% to 10% very easily through these monetary economic policies, and not that quantitative monetary economic policies like changing interest rate, changing money supply, and fixing the reserve requirement. There are other many selective controls, such as the Fed can decide, okay, which sectors to be boosted and which sectors the flow of money needs to be contained in which sectors. So that way there are selective control. One is quantitative control methods or quantitative methods, and another is qualitative methods. So if the Fed chair uses qualitative methods also regularly, the US economy can grow much faster than 4% or 5%, because the actions of the Fed are swift and the Fed has better knowledge. Well, I won't say better knowledge, because even BlackRock or the big banks, they can easily have a team to gather information about the economy. So it is not that the big corporations cannot have the same knowledge what Fed is having, but Fed has the control over the money supply. So by controlling interest rate, Fed can do only one of the two things. Either it can set the interest rate and let the market decide the quantity of money be supplied in the economy, or the Fed can set the quantity of money being supplied in the economy and let market determine the federal funds rate or the bank rate. So with this, I would say that Professor Damodaran is following what Milton Friedman said about 3 decades ago. Well, he said in 1980s, or rather even 4 decades ago, that federal officials should take coffee, sit there, and don't be active in their job, because they end up making more mistakes. And the reason Milton Friedman gave is that there are long and variable lags of impact of Fed decisions to bring on the economy. Means if today Fed decides, it is possible that its impact may come after 3 months, or its impact may come after 1 month. In that case, the Fed may make another mistake. If it is coming after 3 months, new data has come and Fed takes another decision, then it is possible that Fed might make the second mistake. So that's why Milton Friedman said that Fed should supply money by rule, not by discretion. So they shouldn't do any job, they should just follow the rule that how much is the unemployment rate and how much is the inflation rate. And as per those basis, the Fed should determine the interest rate or money supply as per rule and shouldn't have any discretion. That is what Professor Aswath Damodaran is saying. So he's saying what Milton Friedman already said, and there is nothing new in that. But my statement is giving the new information that if Fed uses qualitative and quantitative methods of money supply, both the methods, then Fed can achieve US economic growth at least by 3, 4, or even 5% extra, because that will be the biggest technological innovation coming from outside. And of course, the government does a lot of government policies influence the economy a lot. The recessions are brought by Fed and the president. Means the last two recessions, which were 2001 and 2008-9, both were brought by Fed. I can prove it very convincingly, even though the then Fed chair Ben Bernanke may not agree to me, but I can prove that where he made the mistake. And because I was also one of the homeowners in the United States, luckily I had purchased the house in 2007, January 2007. So I was able to purchase my house. Otherwise, when Ben Bernanke came, he made the lending conditions so stringent that entire housing market crashed. And it was solely his fault. It is not the fault of market or this subprime crisis. No, it was not that. It was solely the fault of then Fed chairman Ben Bernanke. But since he is Fed chairman, he would follow whatever he said is the truth or whatever it is. So with this, I end by saying that head talk is very, very interesting. It is very stimulating. You can estimate your country's growth, your own wealth growth. You can predict a stock market's movement if you have really learned the head talk, which is my most interesting topic or my most favorite topic. Thank you very much.